Tyler Crow, it's been a busy roughly 2 months for 3M. It might not seem like it on the surface, but you go back to March, we got word that Bill Brown was going to become CEO of the company effective May 1st. He's in the role. We'll talk about that. We got a lot of updates on settlements over the past couple of months with PFAS, the forever chemicals, with the water supply issues. We got a settlement with the hearing protection, and we just got earnings, and it looks like we've got some resolution with the dividend. So, Tyler, are you ready to update our latest thoughts on 3M?
All that news, and you didn't even mention a major spin-off of its healthcare unit. I mean, yeah, we got a lot to cover. Let's do this.
It's a lot to unpack. It really is. I'm Jason Hall. This is Investing Unscripted. He's Tyler Crow. We're going to get into it. But first, just a reminder, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should go to our special link. You see it on the screen there, fool.com/unscripted. Again, fool.com/unscripted. Go to that link. The Motley Fool's got a great free offer for you. For free, the Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check that out. Okay, Tyler, let's go back in time a little bit because we have a lot of things to talk about with 3M. So first of all, this is about to change. I believe it's increased its dividend every year for was 59 years. It just became 60 years recently. Incredible track record from just a company that's so deeply enmeshed in American industry, right? So many of the products that they make, whether they're consumer facing products or they're used by industry for manufacturing, their adhesives business, so many different things that they do. But the reality is it seems to have lost its innovative edge, seems to have lost its really savvy operation efficiency that made it very profitable, ability to grow its earnings per share year over year. And it's all kind of come to a head more recently with some of the legal issues that they've dealt with. Where do you want to start?
Well, I mean, we want to keep this video to less than 20, 30 minutes because I'm sure I
Yeah,
can
we don't want
well,
a 5-part, 6-hour special, but so we're going to try and keep this to 10 or 15 minutes here.
but one of the things that's been rather clear over the past, I don't know, 6, 7, maybe even 8 years is, like you said, 3M kind of lost its fastball in terms of innovation. For decades, its entire shtick really was like, we're going to develop new products. Those new products are going to hit the market and they're going to become blockbusters that, because of such high volume, we're going to be able to grow sales, grow margins on basically operational efficiencies without having to do a lot of pricing. What I think what ended up happening, and not to get too vicious, but I feel like the bean counters hit 3M a little bit too hard over the past decade or so. Kind of looked at that R&D and be like, well, we're not getting everything out of all these projects, as if the R&D system is a pure linear discovery agent. Basically, with R&D budget kind of dwindling, that innovation started to go away. And when sales started to stagnate, they started making acquisitions, which wasn't really a forte of the business. And all of a sudden, you're making acquisitions. Maybe you're not making the best ones. All of a sudden, returns on capital start to decline, margins start to decline. And at the same time, management is just like going through all these restructurings, uh, issuing guidance that they never hit for 4 or 5 straight years. It was just a lot of nothing by itself, would you say was like awful company killer, but it was just, it almost seemed like the death of a thousand cuts sort of thing, where it was just kind of bleeding out slowly.
Very much the erosion of so many of the things that made this a great and profitable company. So this is, and it's a little lumpy, and there's some cyclicality because of different end markets that it supplies. But this is 2014 through 2022. I didn't include 2023 because there was some big one-time hits that they took that make it hard to really kind of look at the chart. But again, the key thing, the operating margin, the purple line up here, you can see it kind of peaked 2016, 2017, and then fits and starts has steadily eroded. And then net margin, so this includes all of the other expenses that are not operating expenses as well. Same thing. We've seen that continue to erode. Again, just for the sake of transparency, again, we've seen big impacts from one-time costs related to litigation and other expenses that it's taken. So we've seen kind of the core business is weakened, like we've talked about. And then here more recently, and we made some videos last year where we highlighted this as substantial risks that investors really needed to consider. And I think we've seen it come to a head. Investors that were looking for dividend, safe dividend growth, thinking that 3M was a good beaten down, high yield, safe dividend stock to buy because of that 59-year now 60-year track record of growing the dividend. And we talked about those two big litigation risks.
I'm going to lump these in to go really quick here, but with the chlorofluorinated PFAS, the forever chemicals that have been an issue, combine that with the service arms litigation, we're talking about $18 billion worth of payouts over the next several years.
But yeah, $18 billion. And that specifically deals with, again, the combat arms earplugs for U.S. service members and the public water suppliers.
Right.
With PFAS.
Does not include any potential lawsuits that could come from health-related issues from PFAS. So if there were some sort of class action lawsuit related to health-related issues from these chemicals, cancers, things like that, that's still something that's kind of looming on the horizon. So we're not out of the water yet, but we do have two definitive answers on these things. And so that gives a company a rough idea of what it is, but it's not good. But we're kind of highlighting some of the things we've talked about before. And this all really just kind of came ahead this quarter because we have seen some major changes in this quarter. Management, it seemed to me, and correct me if I'm wrong or if you disagree, but it seemed like they finally ripped off the Band-Aid here.
Yeah, I think so. I mean, I think they've found religion, maybe another way to think about it, in terms of the realities of what they're facing with these big expenditures, close to $20 billion that's going to need to go out the door. The continued erosion of the margins of the business, revenues that have stagnated, right? Let's not ignore that. It's not like the company is pumping out lots of innovative new products that are coming to market, that are taking market share, that are going to be the future revenue and profit growth of the business. That part of the business is stagnated as well. So you have to make changes. You have to make cuts. So one thing they've done, and this is more kind of a product of just making the business more efficient and cleaner and easier to focus on. And you mentioned it in the open, and that's spinning off its healthcare business. And it's called Solventum. And they did that on April 1st. So it's been over a month ago that they did that. Briefly want to talk about that, Tyler?
The way they structured it was it takes some of the debt off of 3M's business, as well as bringing in some cash in the door. I think they raised about $7 billion from the spinoff. But healthcare, one of the things that I do appreciate about healthcare versus what's kind of left at 3M, which is electronics, automotive, personal care, safety, industrial, those are pretty cyclical industries. Healthcare is not as cyclical. And so we've just, like I said, discussed this before, actually kind of like Solventum a little bit more as a long-term investment, but it gave it the necessary cash infusion that it needed to hopefully make the changes necessary. And this is, let you jump back in here because we saw a major management change and you're a little bit more familiar here.
So Bill Brown is now the CEO of the company. And the announcement actually came out in mid-March that he was going to be coming in effective May 1st. I want to bring this up on the screen because this is what the stock has done, Ty, since March 11th, the day before the announcement was made that Bill Brown was going to become the CEO. You can see the stock sold off a ton. Part of that was that April 1st, you see the spin out of Solventum happened. So the stock price adjusted down based on that too, right? Revaluing the business based on that. It's come back up a little bit, but it's still down about 11%. Since that announcement came out, he might not be very familiar to a lot of people, especially anybody that hasn't followed the aerospace and defense industry. He was at United Technologies for a long time. And then he joined Harris Corporation as president and CEO. In 2019, Harris and L3 Technologies merged together. By then, Brown was the chairman and CEO of Harris. So he signed off on that deal to do the merger when L3 and Harris merged together. For those who don't know, that's kind of it's a communications defense business, and they're one of the leaders in that space. And what's really interesting, Tyler, and something you talk about a lot, is empire building, right? You have these businesses that expand and make acquisitions and just, they get bigger and bigger, but they don't get better. They don't get more profitable on a per share basis. And what's interesting is that even though Brown led this merger of these two large companies in the defense business, is what happened from the closure of that merger over the next 3 years in his term as CEO was a business that steadily got better and better at the core things that it did, divesting other assets. They weren't trying to build an empire that got bigger and bigger than L3 Harris. He took that business, divested assets that didn't really fit with their core, and really turned it into a profitable, extremely important defense business that's focused on communications hardware. And he's stepped away from that in 2022. And our colleague and friend, Lou Whiteman, he and I were chatting about it. And he quipped that he thinks Brown might be a little disappointed that he had already taken the 3M job when the Boeing job came open. That might have been like the perfect turnaround opportunity for him. But the point is this is a very tenured, experienced executive who's worked at these really large businesses before, that knows how to focus the businesses, allocate capital well, trim the fat, get the chaff from the wheat, however you want to describe it. He's done that before, Tyler. So I think that's a real positive thing. Again, the market didn't seem to love the announcement that Brown was coming in. The stock certainly hasn't popped after earnings. It's been relatively flat since the company reported. And I think at this point, there's a whole lot of show me going on. And part of that, Tyler, is, well, Bill Brown's boss is the former CEO, who's now become chairman of the company, who was the CEO of 3M for a number of years. And prior to that, he was the highest named executive running the entire company's operations, right? We just talked about a company whose operations have not generated tremendous value for investors for the past decade or so, and our concerns that we have there. So, Tyler, with that said, we have answers. We have a lot of answers about concerns. We have answers about who is going to be the key leader to try to affect change at this business. One other little piece of information we need to mention, we should have mentioned it sooner, that they have effectively announced that the dividend's being cut. They haven't explicitly said it, but they are saying that in May, when they announce their next dividend, the expectation is they're going to pay out 40% of free cash flow. That's the dividend policy going forward. That means the dividend is going to get cut close to in half, maybe not exactly in half, maybe a little bit less than that, but a dividend cut is coming for this dividend king very soon. That bodes well. Maybe it doesn't sound like it if you've held the shares expecting a dividend to be safe, but I think it bodes well for a company that needs to be turned around. Where do you stand on 3M right now? What do you think investors should do?
Well, I think I like the blueprint, bringing somebody from outside who has a track record in value creation from a sprawling business. We've actually seen this before. It happened in GE with Larry Culp. Like, he came in and took a sprawling empire, cut it down to the respective parts, and let them all loose on the market to do what they do best. And it's been a resounding success so far. So we can see the blueprint of it working. I think you hit on the key there. Is Bill Brown going to be given the leash long enough to execute this without getting gruff from the board of directors? Having somebody who ran the business for a really long time in Mike Roman, and then all of a sudden somebody comes in and says, garbage, get it out of here. It might not go over well. So let's see. I think it could work, but like you said, there's some headwind, and we actually have to see tangible progress before we actually believe it.
Yeah, I think I agree. When we've talked about this one before, typical of you and I, the differences in our styles and our focus, you've been very cautious, cautioning to investors about looking at this. And I have as well, from the perspective of thinking about the dividend being safe. I've towed the line for a year now that the dividend was at risk. And we're learning that's the reality, right? The dividend is almost certainly going to get gutted, as it should, because they need to free up that cash flow to focus on building a better 3M, right? To create value for investors. But I have been relatively steadfast and also saying that I think that there was some interesting risk reward if management could demonstrate the wherewithal and the focus to actually try to turn the business around, because there are some incredibly valuable assets there. It's a large business that at scale should be able to pump out cash. They just need the right people to be able to do it. So I think right now, I think the risk profile is probably better. I don't think this is a value play. This is a turnaround. You're not buying this company while it's cheap. Its cash flows are still very much down. They're going to have to spend a ton of money to fix the business. They still have the litigation outflows that they're dealing with. They've already kind of booked some of that. Spinning off the healthcare business, the cash flows are going to be reduced from that. So thinking about this as a turnaround is a much better approach. And typically with turnarounds, the way I think about them is maybe take a small position to start if you're interested, and then let the management of the company earn more of your capital as they demonstrate that they're actually doing it. And once Brown is in, he's been in for 6 days at this point. Give him 6 months, a couple of quarters, see what the numbers are looking back, hear the cadence of what they're saying. Are they backtracking? Are they moving the goalposts? Really focus on what management is saying in relation to what the business is doing in the context of what's changed in the prior quarters and years, and then think about building out a position over time. If they're not earning more money from you, don't give them more money just because the stock still looks cheap. They need to earn it with business performance.